Before we begin, please remember that this video is for informational and educational purposes only and does not constitute financial or legal advice. The world of insurance is complex and subject to change. For decisions regarding your specific circumstances, you should always consult with a qualified and licensed insurance professional in your state. You get that letter in the mail, your heart sinks just a little. It's your auto insurance renewal, and you already know what's inside without even opening it. Your premium has gone up. Again, you haven't had a single ticket. No accidents. Your car is a year older, it's worth less, yet you're paying more. You feel completely powerless, like just another line item on a spreadsheet for some massive, faceless corporation in a skyscraper 1,000 miles away. You call their 1-800 number, navigate a phone tree from hell, and finally speak to someone who gives you a scripted, unsatisfying answer about rising costs in your area. It's frustrating. It's infuriating. And it makes you wonder, is there a better way? What if your insurance company wasn't some distant corporate giant? What if it was an organization where you weren't just a policy number but a member? An organization where the agents live in your community, and the profits, instead of going to Wall Street investors, are used to keep rates low for people just like you? This isn't a fantasy. This organization exists. It operates in nearly every state, consistently receives some of the highest customer satisfaction ratings in the entire industry, and yet, for millions of Americans, it remains one of the best-kept secrets in personal finance. We're talking about Farm Bureau, and over the next several minutes, we are going to pull back the curtain on this uniquely American institution. We're not just going to tell you what it is, we're going to show you how it operates. We'll dissect its strange and fascinating structure, explore why you have to pay a fee just to become a customer, and reveal the truth behind their award-winning service. We will look at the good, the bad, and the unexpected, so that by the end of this presentation, you will know definitively whether Farm Bureau auto insurance is the right choice for you and your family. To understand how Farm Bureau insurance works today, you have to go back a century. The year is 1919. America is a nation of farmers, but these farmers faced a huge problem. They were at the mercy of powerful railroads, unpredictable weather, and volatile markets. To have a voice, to gain some control over their own destinies, they banded together. They formed a grassroots organization, a non-profit advocate for the American farmer. They called it the American Farm Bureau Federation. Their goal was simple: to ensure the prosperity and well-being of the families who fed the nation. But they quickly ran into another roadblock: insurance. In the early 20th century, big insurance companies, based in the cities, saw farming as a massive risk. They saw barns as fire hazards, tractors as dangerous machinery, and rural roads as a recipe for disaster. So they charged farmers sky-high premiums, or in many cases, refused to insure them at all. Imagine trying to run a business, trying to support your family without that fundamental safety net. The farmers of the Farm Bureau Federation realized that if they wanted fair, affordable insurance, they would have to do it themselves. And that is the critical, fundamental difference. Farm Bureau didn't start as an insurance company that decided to sell to farmers. It started as an organization of farmers that created an insurance company for its members. This isn't just a quaint origin story. It is the very DNA of how the company operates to this day. It's the reason it's structured unlike any other major insurer in the United States. You see, if you look for the Farm Bureau headquarters on a map, you won't find a single massive corporate campus like you would for Progressive in Ohio or Geico in Maryland. That's because there isn't one single Farm Bureau insurance company. Instead, it's a federation. Think of it like the United States itself. You have the federal government, but each state has its own government, its own laws, and its own way of doing things. Farm Bureau is the same. There are individual, state-level Farm Bureau insurance companies. You have Kentucky Farm Bureau, Texas Farm Bureau, Florida Farm Bureau, and so on. Each of these state companies is a separate entity. They have their own CEO, their own board of directors, their own underwriting rules, and they set their own rates based on the unique conditions and risks within their own state. They are all linked together by the heritage and the guiding principles of the American Farm Bureau Federation, but your policy is with your state's company. This is why you can't just go to a generic farmbureau.com and get a quote for the whole country. You have to go to your state's Farm Bureau website. It's also why the experience, the coverage options, and the price can vary dramatically from one state to another. A policy from California Farm Bureau might look very different from one issued by Iowa Farm Bureau. This federated model allows them to be incredibly specialized and responsive to local needs, but it can also be confusing for consumers who are used to the one-size-fits-all approach of national brands. This unique structure leads directly to the single biggest question and point of confusion people have about Farm Bureau: the membership requirement. With virtually every other insurer, you call up, get a quote, and if you like the price, you buy a policy. Simple. With Farm Bureau, there's an extra step. Before you can even buy a policy, you have to become a member of your state's Farm Bureau organization. This involves paying an annual membership fee. This fee typically ranges anywhere from $25 to over $100 a year, depending on your state. And no, you do not have to be a farmer to join. That is the number one myth. While the organization maintains its deep roots in agriculture and continues to be a powerful advocate for farming communities, membership is open to everyone. Teachers, software engineers, doctors, mechanics, it doesn't matter. You pay the fee, you become a member. Only then can you access their insurance products. So what is this fee? Is it just a clever way to squeeze more money out of you? For many people, this is a deal breaker. They see it as an unnecessary annual tax on top of their premium. Why should I pay a fee just for the privilege of being your customer? And that is a perfectly valid question. The answer, according to Farm Bureau, is that you're not just buying a product, you're joining an organization. That membership fee doesn't go to the insurance company. It goes to the nonprofit Farm Bureau Federation in your state. It funds their advocacy work, their educational programs, their community initiatives, and it gives you access to a whole suite of other benefits. These can include discounts on everything from cars and hotels to prescription drugs and farm equipment. In some states, members get access to special financing, estate planning services, or even exclusive health insurance plans. The core idea is that the insurance is just one benefit of being a member, albeit the most significant one for most people. The health of the insurance company and the health of the member organization are intertwined. A strong, active membership base allows the organization to thrive, which in turn supports the insurance company that was created to serve those very members. It's a circular, self-sustaining model. But the question remains for you, the modern consumer. Does it actually work in your favor? Is the value of the lower premiums and acclaimed customer service greater than the cost and hassle of the annual membership fee? And how does a company with farm in its name really handle the complexities of a multi-car pileup on a busy interstate or the theft of a vehicle in a dense urban neighborhood? The answer is more complex than you might think. It's a structure that's both deceptively simple and incredibly intricate, and it's the key to understanding everything about this company. To grasp how Farm Bureau operates, you first have to understand that it is not one single monolithic corporation like Geico or Progressive. Instead, it's a federation. Think of it like the United States itself. You have the federal government in Washington, D.C., but you also have 50 individual state governments, each with its own laws, its own budget, and its own unique identity. Farm Bureau works on a very similar principle. At the very top, you have the American Farm Bureau Federation, or AFBF. This is the national organization, the equivalent of the federal government in our analogy. Founded in 1919, its primary role isn't selling insurance, it's advocacy. The AFBF is one of the most powerful lobbying groups in the country, representing the interests of farmers and ranchers on Capitol Hill. They engage in policy development, fight for legislation that supports American agriculture, and act as the unified national voice for the entire organization. When you hear about debates over farm bills, trade policies, or environmental regulations affecting agriculture, the AFBF is right there in the thick of it. But here's the critical part. The AFBF itself does not write a single auto insurance policy. It doesn't have claims adjusters or underwriters. It is the ideological and political mothership, but the day-to-day business of insurance happens at the next level down. This next level is the State Farm Bureau. Every state, plus Puerto Rico, has its own independent Farm Bureau organization. This is where the real power and the actual insurance operations reside. The Virginia Farm Bureau is a completely separate entity from the Texas Farm Bureau, which is separate from the California Farm Bureau. They are all members of the National AFBF Federation, but they operate autonomously. They have their own presidents, their own boards of directors elected by members from within that state, and their own distinct missions and goals tailored to the needs of their local members. Now, here's the million-dollar answer to how the insurance actually works. These individual state farm bureaus are the ones that either own or are affiliated with an insurance company. So when you buy Farm Bureau insurance, you are not buying a policy from one national company. You are buying a policy from a company like the Virginia Farm Bureau Mutual Insurance Company, or the Texas Farm Bureau Insurance Companies, or the Farm Bureau Financial Services Group, which serves several states in the Midwest and West. These are separate, state-chartered, and state-regulated insurance carriers. The money you pay in premiums, it stays largely within that state-level ecosystem to pay for claims made by your fellow members in that same state. The adjusters who come to inspect your vehicle after an accident, they are employees of your state's Farm Bureau Insurance Company. They live in your communities, they understand the local laws, the local repair shop rates, and the specific driving conditions of your area. This is the fundamental difference. While a national carrier might have a regional office in your state, their operational brain is often located hundreds or thousands of miles away. With Farm Bureau, the entire insurance operation, from underwriting the policy to processing the claim, is managed at the state level. This federated model is also the reason for that mandatory membership fee. This is a point of confusion for so many people, and it's often a barrier for potential customers. Why do you have to pay $50 or $100 a year just for the privilege of being a customer? The answer is, you're not just a customer. You're a member. That annual fee doesn't go to the insurance company. It goes to the State Farm Bureau organization. It's your membership dues. That money funds the entire non-insurance side of the operation. It pays for the advocacy work at your state's capital, fighting for issues that matter to members. It pays for community outreach programs, agricultural education initiatives, safety seminars, and the upkeep of the local county offices that serve as the grassroots foundation of the entire structure. Essentially, the insurance is a benefit of membership. You join the Texas Farm Bureau organization, and as a member, you gain access to the products offered by the Texas Farm Bureau Insurance Companies. This is a model that was common in the early 20th century with fraternal organizations and mutual aid societies, but it's quite rare today in the insurance world. It also explains the deep-rooted loyalty many members feel. They don't just see it as a transactional relationship with an insurance provider. They see themselves as part of a larger community organization that represents their interests and values. So, let's circle back to that multi-car pileup on the interstate or the stolen car in the city. How does a company with farm in its name handle these modern, often urban problems? The name is a reflection of its heritage, its history, and its core advocacy mission. But the insurance operation is a modern, sophisticated, and highly localized machine. The Ohio Farm Bureau's insurance arm understands the unique risks of driving in Cleveland during a lake-effect snowstorm. The Arizona Farm Bureau's insurance company is intimately familiar with the challenges of monsoons in Phoenix and the risks of dust storms on I-10. They are not a farm insurance company in the sense that they only know how to insure tractors and barns. They are a state-based insurance company, run by locals for locals, that happens to be an arm of a member organization founded by farmers. This structure allows them to be incredibly nimble and responsive. Because their risk pool is contained within a specific state or region, they can tailor their rates and policies with a precision that a national carrier, which has to balance the risks of hurricanes in Florida with blizzards in North Dakota, simply cannot. It's a model of decentralized power. The National Federation provides the brand, the unity, and the political clout. But the state organizations provide the actual product, the service, and the local touch. This is why your experience with Farm Bureau in Georgia might be vastly different from someone's experience in Iowa. You're dealing with functionally different companies operating under the same historic banner. This unique structure is their greatest strength and, in some ways, their most confusing attribute. It creates a powerful sense of community and local accountability. When you call for help, you're not calling a massive, faceless call center on another continent. You are most likely talking to someone in your own state, maybe even in a nearby town. The person handling your claim understands that the traffic on I-285 in Atlanta is a nightmare, or that a hailstorm in rural Nebraska can be devastating. This local expertise is something that no amount of data or algorithms can fully replicate. It's the human element, baked into the very DNA of their federated system. But this same system also means that their services, their rates, and even their digital tools can vary dramatically from one state to another, creating an inconsistent brand experience for people who move or travel frequently. It's a trade-off: hyperlocal expertise in exchange for national uniformity. And understanding this trade-off is the first step in deciding whether this century-old model is the right fit for your 21st century life. So how do you get access to this network of state-specific insurance giants? This is where Farm Bureau fundamentally diverges from almost every other insurer you've ever heard of. You don't just call up and buy a policy. You have to join the club first. and I mean that literally. To get Farm Bureau insurance, you must first become a paying member of your state's Farm Bureau organization. This isn't a complex process, but it is a required one, and it's probably the single most misunderstood aspect of their entire operation. Think of it this way: Geico, Progressive, State Farm, they sell a product. That product is an insurance policy. Farm Bureau, on the other hand, sells access to a community and organization. And one of the biggest benefits of being in that community is the exclusive right to purchase their insurance products. The insurance is a perk of membership, not a standalone product available to the general public. This means that before you ever pay a single dollar in insurance premiums, you will pay an annual membership fee. This fee doesn't go toward your auto coverage. It's a separate transaction, and it goes directly to the Farm Bureau member organization in your state. How much are we talking about? It varies, but you can generally expect it to be somewhere between $25 and $100 per year. It's not a bank-breaking amount for most people, but it's a non-negotiable cost of entry. If you get a quote that seems incredibly low, you have to remember to mentally add in this annual fee to calculate your true yearly cost. Now, the multi-million-dollar question is, where does that money actually go? What are you paying for? This is the heart of the Farm Bureau model. A huge portion of that fee funds the organization's primary mission, which existed long before they even got into the insurance game: advocacy. The Farm Bureau is first and foremost one of the most powerful lobbying organizations for the agricultural industry in the United States. They call themselves the voice of agriculture, and they take that role very seriously. Your membership dues help pay for lobbyists in your state capital and in Washington, D.C. They fund campaigns to influence policy on everything from water rights and land use regulations to international trade deals and farm subsidies. They are constantly working to shape legislation in a way that benefits the agricultural community. When you become a member, whether you're a farmer or a software developer living in a downtown apartment, a piece of your fee is supporting this political and legislative machine. For some people, this is a major draw. They believe in the mission, they want to support American farmers, and they see their membership as a contribution to a vital cause. For others, it can be a point of friction, feeling forced to contribute to a political lobby they may not fully align with, just to get access to a good car insurance rate. It's a crucial factor to consider. But the money doesn't just go to lobbying. It also funds a vast array of community and educational programs. Your dues might support local scholarships for students pursuing agricultural degrees. They might fund safety workshops for operating farm equipment, or youth programs like 4-H and Future Farmers of America. They often host community events, county fairs, and provide educational resources to schools. It's about weaving a fabric of support for rural and agricultural life that goes far beyond a balance sheet. This is the community aspect of the membership, and it's a big part of their brand identity. This brings us to the most common myth about Farm Bureau, one that stops millions of people from ever even getting a quote. You hear the name Farm Bureau and you think, well, I don't own a farm. I don't even own a potted plant. This isn't for me. For decades, this has been the company's biggest marketing hurdle. But here's the truth. In nearly every state, you absolutely do not need to be a farmer to join. Membership is open to everyone. It's a legacy name that reflects their origins, not their current customer base. Think of it like USAA. They started with a laser focus on serving military officers. Over time, they expanded to include all military members and their families. Their name still reflects their heritage, but their membership is much broader. Farm Bureau is the same. They started as an organization for farmers by farmers, but to grow their insurance business and their advocacy influence, they opened the doors. Today, their membership is a diverse mix of rural, suburban, and urban residents from all walks of life. So let's be crystal clear. If you've ever dismissed them because you thought you weren't eligible, you were probably mistaken. Once you've paid your dues and you're in the club, what else do you get besides the right to buy insurance? This is where they try to make that annual fee feel like less of a tax and more of an investment. Your membership card is also a discount card. Farm Bureau leverages the collective buying power of its millions of members to negotiate corporate discounts on a massive scale. The specific benefits vary by state, but they are often surprisingly valuable. We're talking significant discounts on new vehicles from companies like Ford and John Deere. You'll find deals on hotel chains, rental cars, and even theme park tickets. There are often partnerships for health services, offering discounts on prescription drugs, vision, and dental care. You might get a percentage off your bill at certain auto parts stores, or get a deal on home security systems. For many members, if they use just one or two of these benefits a year, say they buy a new set of tires or take the family on a small vacation, the savings can easily equal or exceed the cost of the annual membership fee. It's a value proposition designed to make you feel like you're getting a tangible return on that initial investment, turning the fee from a simple cost into a portal for savings. So, when you put it all together, the picture becomes clearer. You're not just buying a policy from a faceless corporation. You're joining a state-chartered organization with deep roots and a specific mission. You pay a fee that supports that mission both politically and in the community, and in return you get a bundle of benefits. You get access to a suite of insurance products tailored to your state, and you get a list of discounts that can save you money on everyday purchases. It's a completely different way of thinking about insurance. The transaction is layered. It's part financial, part philosophical, and part practical. For some, the idea of paying an extra fee and indirectly supporting a lobbying group is an immediate deal-breaker. They just want the cheapest, simplest policy, no strings attached. But for millions of others, it's a model that makes perfect sense. They see the premium savings on the insurance itself as more than covering the membership fee. They appreciate the community programs, and they value the member-only discounts. Understanding this membership model is non-negotiable. It is the gatekeeper to everything else Farm Bureau offers. It explains their structure, their purpose, and their unique place in the market. So now that we've paid our dues, we've walked through the gate, and we are officially members. We've unlocked the ability to actually buy their insurance. But what does that insurance actually look like? Are their policies for a standard sedan different? How do they handle claims? And how does that famous local agent, the person you'll actually be dealing with, fit into this complex puzzle? That's where we're going next. So, what does that policy for a standard sedan actually look like? At first glance, a Farm Bureau auto policy document looks remarkably similar to one from any other major carrier. It's a contract, filled with the standard language of insurance that can make anyone's eyes glaze over. You'll see the familiar pillars: liability coverage, which is the part that's legally required in most states, covering damage you cause to others. Then there's collision coverage, which pays to repair your own car after an accident. And comprehensive coverage, for all the other chaos life throws at your vehicle: theft, a tree branch falling on it, a deer deciding to redesign your front grille. But the difference isn't always in the what, it's in the how. Because Farm Bureau operates as a federation of state-level companies, the specific bundles, endorsements, and discounts can vary significantly depending on whether you live in Iowa, Texas, or North Carolina. One state's Farm Bureau might offer a fantastic disappearing deductible, where your deductible amount decreases for every year you go without a claim. Another might have a unique partnership with local agricultural equipment dealers, offering a special rider if you ever need to tow a small trailer. These aren't groundbreaking innovations, but they are tailored, granular benefits that stem from their deep local roots. It's the first clue that you're not dealing with a one-size-fits-all national behemoth. However, a policy is just a promise on paper. It's a hypothetical agreement until the moment you hear that sickening crunch of metal and glass. That's the moment of truth. That's when you find out what you've really been paying for all these years. So let's step away from the theory and into a real-world scenario. Imagine a driver, we'll call her Emily. She's a 28-year-old elementary school teacher living in a mid-sized town in Indiana. She drives a reliable 3-year-old Honda Civic. She's a Farm Bureau member, not because her family farms, but because when she bought her first car, her dad told her to go see Bill down at the Farm Bureau office. He'll take care of you. It's a rainy Tuesday afternoon. Emily is pulling out of a tight parking spot at the grocery store. Her view is partially blocked by a massive pickup truck. She inches out, looking both ways, but a car whips around the corner of the aisle just a little too fast. Bam! It's a low-speed collision, but the impact is jarring. The other driver's fender is dented, and Emily's rear bumper is cracked and hanging awkwardly. No one is hurt, thankfully, but the panic sets in. Hearts are pounding. This is Emily's first ever accident. The other driver, a man in a business suit, is already on his phone, looking annoyed. He's insured by one of the giant national companies. Let's call them Omnicorp Insurance, the kind you see advertised every 15 minutes during a football game. Emily's hands are shaking as she fumbles for her phone. She doesn't have an app with an animated gecko. She doesn't have a 1-800 number to a call center in another time zone. She has a business card in her glove box with a local number on it. She dials. Farm Bureau, this is Bill. It's not a recording. It's not an automated menu asking her to press 1 for English. It's Bill. The guy who sold her the policy. The guy who asked about her dad last time she was in the office. Bill, she says, her voice trembling a bit. It's Emily. I've just been in an accident. And this is where the entire experience diverges. The other driver is now on hold with Omnicorp, listening to tinny music, waiting to report the claim to a stranger who will ask for his policy number before they even ask if he's okay. Bill, on the other hand, immediately shifts from insurance agent to crisis manager. His voice is calm and reassuring. Okay, Emily, first things first. Is everyone all right? Are you in a safe place? He walks her through the immediate critical steps. Don't admit fault. Exchange information, name, insurance, driver's license. Use your phone to take pictures of everything. Both cars, the license plates, the damage, the surrounding area. He stays on the phone with her until she's collected all the information and the other driver has left. He tells her, "Don't you worry about the rest. I'll get the claim started on my end right now. You'll hear from an adjuster, probably a guy named Mark, within 24 hours. He's good people. In the meantime, just try to relax and drive straight home if the car is safe." Emily hangs up, still shaken, but the panic has subsided. She feels like someone has her back. Meanwhile, the Omnicorp driver has finally gotten through to a representative, read off his policy number, and formally reported the incident. He's given a claim number and told an adjuster will be in touch in the next 48 to 72 business hours. The call was efficient but cold and impersonal. He's just another number in a queue. The next day, just as Bill promised, Emily gets a call from Mark, the Farm Bureau claims adjuster. He's based in Indianapolis, just an hour away. He's polite, empathetic, and already has all the details from Bill. He asks for her side of the story. Because the accident happened in a private parking lot, he explains that fault can be tricky, but he assures her they will handle her repairs under her collision coverage regardless. He then says something that highlights the local network. Now for the repairs, you can take it to any shop you want. But if you don't have a preference, I can tell you that Miller's Body Shop right there on Main Street does great work. We've been sending folks to them for over 20 years. They do the job right and they bill us directly. So you'll just have to pay your deductible. Emily knows Miller's. She drives past it every day. The choice is easy. She drops her car off that afternoon. The shop owner already has a heads up from Mark. Her rental car, which is covered under her policy, is waiting for her. The whole process is seamless. Let's contrast this with the other driver. His Omnicorp adjuster is based in a massive claims center in Arizona. She's professional, but she's juggling hundreds of cases. She recommends he use one of their preferred network shops, a national chain on the other side of town known for getting cars in and out as fast as possible. The communication is all through emails and a clunky online portal. When he calls with a question, he gets a different person every time, each one needing to pull up his file and get reacquainted with his case. It's frustrating. It's impersonal. It works, but it feels like grinding gears. A week later, Emily's Honda is ready. It looks brand new. She pays her $500 deductible to the shop, and that's it. Farm Bureau handles the rest. Bill even calls her a few days later just to check in, to make sure she was happy with the repairs and the overall experience. This story, this process, is the absolute core of the Farm Bureau value proposition. It's not about having the flashiest app or the funniest commercials. It's about leveraging a hyperlocal, community-based structure to make a stressful, dehumanizing experience feel personal and manageable. The agent isn't just a salesperson. They are your advocate, your first point of contact, your guide through the bureaucratic maze of a claim. The adjusters and recommended repair shops are often part of that same local ecosystem, creating a network of familiarity and, ideally, trust. This is the system working exactly as it's designed to. It's the promise of that Main Street office delivered in the moment it matters most. But this raises a crucial question. This is the best-case scenario. What happens when the system breaks down? What happens when your local agent isn't as competent or caring as Bill? What happens when the claim is more complex, involving serious injuries or a legal battle? Is this community model a true strength, or can it become a liability? A small-town system struggling to handle big-time problems? The glowing reviews often highlight an experience just like Emily's, but the negative reviews tell a very different story. A story of an insular network that can sometimes protect its own interests above all else. And that's the dark side we need to explore. So what does it look like when that small-town charm sours? When the handshake deal is forgotten and the fine print takes over? It looks like a slow-motion car crash of a different kind, one that happens not on the highway, but over the phone, through emails, and in the agonizingly slow turning of bureaucratic gears. To understand this, we have to dissect the anatomy of a complaint, because the negative reviews against Farm Bureau aren't just random cries of frustration. They follow a disturbingly consistent pattern, a script that plays out again and again in different states with different families. The first and most common theme is what we'll call the Great Lowball. This is where a member, often a loyal one with years of on-time payments, files a legitimate claim, only to be presented with a repair or settlement offer that is so laughably low it feels like a typo. Body shops quote $10,000 for a repair. The Farm Bureau adjuster offers $4,000. A car is clearly totaled, its frame bent beyond repair. Farm Bureau insists it's fixable, pushing the member toward a cheaper, potentially unsafe repair just to avoid paying out the vehicle's actual cash value. This isn't just about saving a few bucks. For the families involved, it's a profound breach of the core promise of insurance: to be made whole again. It forces them into a fight they never wanted, having to get independent appraisals, argue with adjusters, and spend hours battling the very company they paid to protect them. The second pattern is the ghosting. This is where communication simply ceases to exist. After an accident, the initial call to the local agent might be warm and reassuring, but once the claim is handed off to a regional adjuster, a cone of silence descends. Emails go unanswered for weeks. Voicemails are never returned. The member is left in limbo, their car sitting in a tow yard racking up storage fees, their life on hold, with no information and no idea what's happening. This is perhaps the most psychologically damaging part of the process. It transforms the relationship from one of a trusted community partner to that of an adversarial, faceless corporation. The local agent you know and trust suddenly says their hands are tied, creating a feeling of total helplessness. And that brings us to the third, and most insidious pattern: the agent-adjuster disconnect. This is the structural flaw at the heart of the worst Farm Bureau experiences. You see, the person who sold you the policy, your local agent, the one who knows your kids' names and asks about your farm, often has virtually zero power over the claims process. They are the face of the company, but the decisions are made by an entirely different arm of the organization: the claims department, staffed by adjusters who are often in a different city or state. These adjusters don't know you. They don't care about your loyalty. Their performance is often judged by metrics you'll never see, metrics like claim severity, which is just corporate speak for how little money they can pay out on each claim. So you have this bizarre two-faced experience. Your local agent is on the phone, apologizing, saying they're looking into it, while the adjuster is the one actually calling the shots, denying the claim and refusing to budge. It's a classic good cop, bad cop routine, except both cops work for the same company, and you're the one paying their salaries. This disconnect is what shatters the trust completely. It makes the entire "we're your neighbors" marketing feel like a cruel joke. To see how these patterns converge, let's consider the story of a man we'll call Mark. Mark was a third-generation Farm Bureau member in a rural county. His grandfather had signed up with the same local office back in the 50s. For 40 years, his family had paid their premiums without fail, insuring their trucks, their home, and their equipment. They were the model customer. One afternoon, Mark was sitting at a red light when a distracted driver slammed into the back of his new pickup truck. The collision was severe, buckling the bed and visibly bending the frame. The other driver was ticketed at the scene. Fault was not in question. Mark did exactly what he was supposed to do. He called his agent, a man he'd known for 20 years. The agent was sympathetic. "Don't you worry, Mark," he said. "We'll get this sorted out. That's why you're with us." Comforted, Mark had the truck towed to the best body shop in the county, a place his family had used for decades. A few days later, the call came. It wasn't from his agent. It was from an adjuster in the state capital, 300 miles away. The adjuster's tone was cold and personal. He informed Mark that their initial estimate for the repair was $6,000. Mark was stunned. The body shop had already given him a preliminary estimate of over $17,000, noting that once they got into the frame, it would likely be declared a total loss. Mark explained this to the adjuster. The adjuster's response was chilling. He said their software, using data from national parts suppliers, indicated it could be fixed for $6,000. He accused the local body shop of trying to rip them off. This was the beginning of a 3-month nightmare. Mark was trapped. Farm Bureau wouldn't approve the $17,000 repair, and the body shop couldn't, in good conscience, do a $6,000 patch job on a bent frame. So Mark's truck, his primary tool for his livelihood, just sat. He called his local agent, desperate for help. The agent was full of apologies. He said he'd make some calls and see what he could do. But every time the answer was the same. "I'm sorry, Mark, it's out of my hands. The claims department has final say." The ghosting began. Mark would leave messages for the adjuster and get no response for a week at a time. When he finally did get the adjuster on the phone, the man was hostile, treating Mark not like a loyal member, but like a fraudster trying to scam the system. The adjuster mailed him a check for $6,000, saying that was their final offer. If he wanted more, he'd have to file a formal dispute or hire a lawyer. Think about the betrayal Mark felt. His family had paid tens, if not hundreds of thousands of dollars in premiums to this company over half a century. And when he needed them for the first time for a major clear-cut claim, they treated him like an enemy. The agent he trusted was powerless. The company he believed in was hiding behind corporate policy and lowball software estimates. He wasn't a member of a community. He was a line item on a spreadsheet, a liability to be minimized. Mark eventually had to hire an attorney. The moment a lawyer's letter was sent, Farm Bureau's attitude magically changed. Suddenly, a new adjuster was assigned, and a settlement for the full value of the truck was reached within weeks. But the damage was done. He had to pay a lawyer a third of his settlement, and the trust his family had placed in the company for over 50 years was permanently destroyed. Mark's story isn't an outlier. It is the blueprint of the negative Farm Bureau experience. It's a story about how a structure built on local trust can be completely undermined by a disconnected, profit-driven claims process. The very thing that draws people in, the promise of a personal, neighborly relationship, becomes a hollow front for a rigid and often unforgiving corporate machine. The local agent becomes less of a trusted advisor and more of an unfortunate, powerless buffer between the customer and the real decision-makers. And that's the critical disconnect we have to understand. So what really happens behind the curtain when your claim file is opened? What are the secret rules and internal pressures that decide whether you're treated like Emily or like Mark? The moment your claim is filed, it doesn't land on the desk of a sympathetic helper. It lands in a digital queue, a single line item on a spreadsheet of problems to be solved. And the person who picks it up, the claims adjuster, has a job that is fundamentally misunderstood by almost everyone. We picture a friendly investigator, someone whose purpose is to help us put the pieces back together. The reality is that a claims adjuster is a cost containment specialist. They are the frontline guardians of Farm Bureau's treasury. Their performance isn't measured by how happy you are or by how fully you've recovered. Their performance is measured by something called claim severity. That's industry jargon for how much money they pay out on a claim. A low severity is a win. A high severity is a problem that requires justification to a manager. Imagine an adjuster named Sarah. Sarah doesn't just have your claim. She has 150 other claims just like it. Her phone never stops ringing. Her email inbox is a waterfall of demands, medical records, and angry voicemails. She's under immense pressure from her supervisor to close files. Every file that stays open past 30 days hurts her metrics. A closed file is a good file. And the fastest way to close a file is to pay as little as possible, as quickly as the claimant will accept it. This is the environment in which the fate of your financial and physical recovery is decided. It's not a system designed for empathy. It's a system designed for efficiency and profit preservation. And to achieve that efficiency, the insurance industry, including many of its largest players, has systemized a strategy that insiders sometimes refer to as the 3 Ds: delay, deny, and defend. Let's start with delay. This is the first, most subtle, and psychologically draining weapon. When Mark, our driver who was seriously injured, first filed his claim, he was optimistic. He did everything right. He got a police report, he took pictures, he went to the doctor immediately. He submitted everything to his Farm Bureau adjuster. And then silence. He calls and gets voicemail. He emails and gets an automated reply. A week later, he gets a call back. The adjuster is friendly but says they're missing a specific form. A form he's sure he already sent. So he sends it again. Another week goes by. He calls again. He's told his initial adjuster has been reassigned and his case is now with someone new, who needs to get up to speed. This isn't an accident. This is a strategy. Every delay serves a purpose. It wears you down. It increases your financial pressure. Your medical bills are piling up. You're out of work, losing income. The rental car coverage is running out. You're getting desperate. That desperation makes you more likely to accept a lowball offer later, just to make the pain stop. The insurer is also using this time to their advantage. They're collecting information, looking for any inconsistency in your story, any reason to question your claim. They might send you a massive, multi-page medical authorization form that gives them access to your entire medical history, from birth. They're not just looking at your back injury from the crash. They're looking for that time you tweaked your back playing softball in college a decade ago. They're hunting for a pre-existing condition they can use to devalue your claim. Delay is not just poor customer service. It is a calculated tactic of attrition. Next comes the second D, deny. This is where the battle truly begins. Denial doesn't always mean a flat-out no. More often it's a yes, but they might agree the accident was the other driver's fault, and they'll pay to fix your car. But your injuries, that's another story. The adjuster, using the information they dug up during the delay phase, might say, "Well, Mark, we see you saw a chiropractor for back pain 7 years ago. Our medical expert believes your current condition is an aggravation of a pre-existing issue, so we can only offer 20% of your medical costs." Or they might deny specific treatments. Mark's doctor recommends 12 weeks of physical therapy. The insurance company's nurse case review. A person who has never met Mark or examined him reviews the paper file and decides that only 4 weeks are medically necessary. Anything beyond that is on Mark's dime. They will nitpick every single bill. They'll question every procedure. They'll use their own internal billing software to argue that the hospital charged too much, that the rates are above what is usual and customary for the area, and therefore they will only pay a fraction of the bill, leaving Mark to fight with the hospital over the remainder. This is the death by 1,000 cuts approach. They are turning Mark's recovery into a grueling full-time job of paperwork and phone calls, forcing him to justify every single step of his own medical care. The goal is to make the process so frustrating, so infuriating, that he'll eventually give up and accept their pennies on the dollar offer. For the insurance company, every treatment they successfully deny, every bill they reduce is pure profit. And if you refuse to give up, if you keep fighting, keep providing documentation, and insist on what you are rightfully owed, then you encounter the final, most intimidating D, defend. This is the fortress. The adjuster's friendly tone vanishes. The conversation is over. You receive a letter, not from the adjuster, but from Farm Bureau's legal department, or an outside law firm they've hired. The letter is cold, formal, and filled with legal jargon. It states the company's final offer, and makes it clear that any further action will be vigorously defended. This is a declaration of war. They are daring you to sue them, and they know the odds are in their favor. They know that an average person like Mark doesn't have thousands of dollars to hire an attorney and pay for expert witnesses and court filing fees. They have an entire team of salaried lawyers who do nothing but handle these cases all day, every day. Cost them virtually nothing to fight you. Could cost you everything. The defend strategy is a powerful tool of intimidation. It's designed to make you feel small, isolated, and powerless. It's a corporate giant telling the individual, "We have more money and more lawyers than you. We can wait this out longer than you can. Give up." For many, this is the final straw. They take the terrible offer, sign the release, and walk away, leaving tens of thousands of dollars in uncovered medical bills and lost wages on the table, just to escape the fight. But there's one more secret happening behind the curtain. A silent partner in this whole process. It's not a person at all. It's a piece of software. For decades, major insurance companies have used powerful computer programs to evaluate injury claims. The most famous one is called Colossus, but there are many others. These programs are designed to take the human element, the empathy, completely out of the equation. The adjuster takes the data from your claim, the specific injury codes from your doctor, the type of treatment, the duration of care, and feeds it into the computer. The software then cross-references this with a massive database of other claims and spits out a settlement range. That range becomes the adjuster's Bible. Their authority to settle your claim is strictly limited to what the computer says it's worth. And here's the critical part. The system can be gamed. Adjusters learn that certain inputs generate lower values. If they can justify using an injury code for a sprain instead of a tear, the software might calculate a value that's thousands of dollars lower. The software doesn't understand your unique pain. It doesn't know that you can no longer pick up your child, or that you had to give up your favorite hobby. It has no value for human suffering. It is a cold, calculating tool designed for one purpose: to standardize and reduce payouts across the board. It gives the company a shield of objectivity. They can claim their offers aren't arbitrary. They're based on a sophisticated data analysis. But it's an analysis that is systematically skewed in their favor. This is why Mark, with a legitimate, documented injury, gets an offer that barely covers his emergency room visit. His claim wasn't evaluated by a person. It was processed by an algorithm. So why was Emily's experience so different? Why did she get the white glove treatment while Mark was put through the ringer? It's because not all claims are created equal in the eyes of the insurer. The system of delay, deny, defend isn't triggered for everyone. There are certain tripwires, certain claim values, injury types, and policy details that move a file from the pay it and close it pile to the fight it and reduce it pile. Understanding what those tripwires are is the first step in learning how to navigate the minefield. The system is designed to exploit the uninformed and the unprepared. But what happens when a claimant knows the rules of the game? What happens when you know how to document your claim in a way that the computer can't ignore and the adjuster can't deny? When you know the rules, the game changes. The power dynamic, which is so carefully engineered to favor the insurance company, begins to shift. It's no longer about what they decide to give you. It becomes about what you can prove you are owed. This is the secret that turns a vulnerable claimant into a formidable opponent. It's not about being aggressive or confrontational. It's about being methodical, organized, and relentless in one specific area: documentation. You need to build a case so strong, so thoroughly supported by evidence, that denying it or lowballing it becomes a bigger risk for them than simply paying it. Let's call this process building your fortress of facts. This fortress has 3 foundational pillars: immediate evidence, medical certainty, and controlled communication. Get these 3 right, and the entire claims process bends in your favor. Let's start with Pillar 1. Immediate evidence. This begins the second the accident is over, and you've confirmed everyone is safe. Your phone is not just a communication device. It is the most powerful evidence-gathering tool you will ever have. The adjuster will never see the crash scene. The claims supervisor will never see it. The computer algorithm certainly won't. They rely on a sterile one-page police report and a few blurry photos. You are going to give them a high-definition, undeniable record of reality. Don't just take a picture of the dent in your car. Take 100 pictures. Take video. Start wide. Capture the entire intersection, the traffic lights, the road signs, the time of day. Get the position of all vehicles involved before they are moved. Then move closer. Document the damage to your car from every conceivable angle. Get low, get high. Open the doors, look at the frame. Photograph the other vehicle with the same level of detail. Then look for what others miss. Are there skid marks on the pavement? Document them. Is the road wet? Was the sun in your eyes? Capture it. Do a slow, narrated walk-around with your phone's video camera. Speak calmly, describing what you're seeing. This is the front of my vehicle. The impact was here. As you can see, the other car's skid marks begin 20 feet before the stop sign. You are creating a virtual tour of the incident that no one can dispute. This isn't just for the adjuster. It's for their supervisor, and if need be, for a lawyer or a courtroom down the line. While you're there, get the other driver's information, their insurance details, license plate, and driver's license number. Get the names and phone numbers of any witnesses. A witness who is not a friend or family member is incredibly valuable. When the police arrive, be cooperative and state the facts clearly and simply. Don't apologize or accept blame. Just state what happened. I was proceeding through a green light when the other vehicle struck my passenger side. Get the officer's name, badge number, and the police report number. This report is a crucial piece of third-party documentation. Now we move to Pillar 2, medical certainty. This is where Farm Bureau and other insurers make their money by minimizing injuries. After a crash, adrenaline is coursing through your veins. You might feel fine, just a little shaken up. The temptation is to say, "I'm okay," and go home. This is a catastrophic mistake. Many serious injuries, particularly soft tissue injuries like whiplash or herniated discs, don't present symptoms for hours or even days. You must seek a medical evaluation within 24 to 48 hours of the accident. It doesn't matter if you think you're fine. Go to an urgent care clinic or your primary care physician. Get checked out. This accomplishes 2 critical things. First, it prioritizes your health. Second, it creates a medical record that directly links any potential injuries to the accident itself. Insurance companies live to exploit something called a gap in treatment. If you wait a week or two before seeing a doctor because the pain finally became unbearable, the adjuster will argue that something else could have caused your injury in that time. They'll say, "How do we know you didn't hurt your back moving furniture last weekend?" By seeking immediate care, you slam that door shut. And it doesn't stop with one visit. You must follow the doctor's orders to the letter. If they prescribe physical therapy 3 times a week, you go 3 times a week. If they tell you to take medication, you get the prescription filled and you take it. Keep every receipt, every copay, every prescription, every mileage log to and from your appointments. More than that, you need to start a pain journal. This is a simple notebook or a file on your computer. Every day you write down a few sentences. Today my neck pain was a 7 out of 10. I couldn't lift my daughter. I had to leave work early because sitting at my desk was agonizing. I had a headache all night and couldn't sleep. This humanizes your claim. It transforms it from a stack of medical bills into a story of real human suffering. A computer algorithm can't process that, but a jury can. This journal becomes irrefutable proof of your pain and suffering, a category of damages that often exceeds the medical bills themselves. Finally, we arrive at Pillar 3, controlled communication. This is where you take back control of the narrative. Soon after the accident, you will get a call from a friendly, seemingly helpful Farm Bureau adjuster. They will be sympathetic. They will say they just need to ask a few questions to process your claim. And they will ask for your permission to record the statement. You must understand this. The recorded statement is not for your benefit. It is a tool designed to be used against you. The adjuster is trained to ask open-ended, leading questions to get you to say something, anything, that can be interpreted as a contradiction or an admission of partial fault. They might ask, "So you didn't see the other car at all before the impact?" If you say, "No, it came out of nowhere," they can later frame that as you not paying attention. They'll ask how you're feeling. If you say, "I'm okay," even if you're just being polite, they will note it in the file. Claimant stated they were on date. You have the right to refuse a recorded statement. And you should. The polite, firm, and unbreachable response is this: "I'm not comfortable providing a recorded statement at this time, but I am happy to provide all the necessary information in writing." This is a complete game changer. By moving all substantive communication to email, you achieve 3 things. 1. You eliminate the risk of being tricked or misquoted. 2. You create a perfect time-stamped record of every single interaction. The adjuster can't later claim they never received something or don't recall a conversation. It's all there in black and white. 3. It forces the adjuster to be professional and accountable. They are far less likely to use delay tactics or make baseless arguments when they know their words are being permanently recorded in writing. From this point forward, every phone call, if you must take one, is immediately followed up by a summary email. "Dear Adjuster, thank you for the call. To confirm our conversation, you stated that you have received the police report and will be reviewing the repair estimate by Friday. Please confirm if my understanding is correct. You are building your evidence locker piece by piece. By mastering these 3 pillars, immediate evidence, medical certainty, and controlled communication, you are no longer a passive victim in the process. You are the director of your own claim. You are presenting them not with a plea for help, but with a meticulously documented, undeniable case for full and fair compensation. You've taken the very system designed to grind you down and used its own logic against it. You've built a fortress of facts that the claim software cannot dismiss and the human adjuster ignores at their own peril. But what happens when you do all of this and they still push back? What's the next move when your fortress is met with a siege? That's when you learn how to escalate. Escalation isn't about raising your voice. It's about raising the stakes. It's a calculated, methodical process of moving your claim up the corporate ladder, from someone whose job is to minimize payouts to someone whose job is to minimize risk for the entire company. The first step on this ladder is almost always the adjuster's direct supervisor or team lead. You're not calling to complain about the adjuster. That's a rookie mistake that puts them on the defensive. Instead, you're calling to request a review of the file. Your approach is professional, calm, and framed as a simple request for a second opinion. You'll want to get the supervisor's name and direct contact information. You can often get this by simply asking the adjuster, "I appreciate your position, but I'd like to have your supervisor review the documentation I've sent. Could you please provide me with their name and email address?" If they refuse, you can call the main claims number and ask for the supervisor of the claims team handling your case. Once you have that contact, you send a concise, professional email. The subject line should be clear: Request for review claim hashtag, your claim number. In the body of the email, you briefly state the facts and the point of disagreement. Dear Supervisor's name. I am writing to request a review of the current offer on my claim. We appear to have a disagreement regarding the valuation of my vehicle, based on the enclosed market analysis from 3 local dealerships. You are not accusing their adjuster of being wrong. You are pointing out a discrepancy between their valuation and your evidence. You attach your evidence again, the comps, the repair estimates, the photos, the diminished value report. You are making it as easy as possible for the supervisor to see the gap. Supervisors are busy. They manage a team of adjusters, each juggling dozens, sometimes hundreds of claims. They don't have time to reinvestigate every detail. They are looking for red flags, for files where their adjuster may have made a clear error, or is at risk of creating a larger problem. Your job is to make your file that red flag. A well-documented, professionally presented disagreement is a problem they can solve quickly, often by authorizing a small increase to make you go away. They might bump the offer by $500 or $1,000. It might not be everything you want, but it's a tangible result of the first step of escalation. If they hold the line, or if their new offer is still unacceptable, you thank them for their time and move to the next rung on the ladder. This is the claims department manager. This person is further removed from the day-to-day grind. They aren't just managing adjusters, they're managing the supervisors. Their concerns are bigger. They think in terms of department budgets, performance metrics, compliance with state regulations, and avoiding litigation. Your communication with the manager needs to reflect their priorities. Your email subject line now reads, Second request for review and formal dispute. Claim hashtag, your claim number. The language shifts slightly. You are no longer just pointing out a discrepancy. You are formally disputing the claim settlement offer. In this email, you reference your previous communication with the adjuster and the supervisor. After discussions with adjuster's name and supervisor's name, we have been unable to reach an agreement on the valuation of my total loss. This shows you followed the proper channels. You then restate your case, but this time you subtly introduce the language of risk. You might reference the specific section of your Farm Bureau policy that guarantees to make you whole. You might reference the state's Unfair Claims Settlement Practices Act, pointing out that failing to conduct a reasonable investigation or attempting to settle a claim for an amount less than a reasonable person would believe they were entitled to could be a violation. You are not threatening them. You are informing them. You are demonstrating that you are educated, organized, and aware of your rights. You are a bad file to have lingering in their system. Claims managers are judged on their ability to close files efficiently. An open, disputed file that has been escalated twice is inefficient. It's a file that could land on the desk of a regulator or an attorney. This is a risk they want to mitigate. Often, this is the level where you'll see a significant breakthrough. The manager has the authority to make a business decision, to pay a few $1,000s more to avoid a potential $10,000 headache down the road. But if even the claims manager refuses to be reasonable, if they call your bluff and stand by their low offer, you have one more powerful move before you even think about hiring a lawyer. You file a formal complaint with your state's Department of Insurance. Every state has one. This is the government body that regulates insurance companies and protects consumers. And insurance companies, including Farm Bureau, absolutely hate dealing with them. A DOI complaint is a formal black and white mark on their record. It triggers a mandatory response process. They can't ignore it. They are legally required to investigate and respond to the DOI in writing within a specific time frame, usually 14 to 30 days. This process costs them time and money regardless of the outcome. Filing a complaint is usually a simple process you can do online through the DOI website. But what you put in that complaint is critical. This is where all your meticulous record-keeping pays off. You will upload every single piece of evidence you have. Your complaint should be a masterclass in organized storytelling. It should have a clear chronological narrative. On date, the accident occurred. On date, I filed my claim. On date, I received an offer of amount from adjuster name. On date, I submitted a counteroffer with the following evidence attached. And so on. You detail every conversation, every email, every point of contention. You attach your independent estimates, your valuation reports, your comparable vehicle listings, your policy documents with the relevant sections highlighted. You clearly state the violation. For example, Farm Bureau is in violation of State Code 123.45, which requires insurers to conduct a fair and equitable settlement process, by refusing to consider market-correct comparable vehicles in my local area. Finally, you state your desired resolution. I am requesting the Department of Insurance compel Farm Bureau to provide a fair settlement of your desired amount, which is supported by the attached evidence. When Farm Bureau receives that notice from the Department of Insurance, your file is immediately pulled from the regular queue. It's no longer handled by the claims manager. It's often sent to a specialized compliance department or a senior internal review team. These are the people whose entire job is to put out fires and manage regulatory risk. They will look at your file not from the perspective of how little can we pay, but from the perspective of how does this look to a state regulator. They will see your organized evidence, your professional correspondence, and your clear articulation of the facts. They will weigh the cost of paying you what you're asking for against the cost of a protracted fight with the DOI, potential fines, and a black mark on their compliance record. More often than not, a well-founded, well-documented DOI complaint is the key that unlocks the treasury. Suddenly, the phone call you get is from a senior representative you've never spoken to before. The tone is different. It's more conciliatory. They're not looking for a fight. They're looking for a resolution. This escalation path from supervisor to manager to the Department of Insurance is a system of applying increasing intelligent pressure. It transforms you from just another claimant into a serious, credible problem that the system is designed to solve. It's the ultimate test of your preparation and resolve. But what if even that doesn't work? What if you face an insurer so stubborn, so entrenched in their position, that even the threat of a regulator doesn't move them? That's when the game changes entirely. That's when you have to consider bringing in the lawyers. This is the nuclear option. The moment you cross the Rubicon, hiring an attorney to sue your own insurance company is not a decision to be taken lightly. It's a declaration of war. It consumes time, energy, and can be an immense emotional drain. But when you've been wronged, when a company you paid for protection has abandoned you at your most vulnerable moment, it's often the only path left. This is David versus Goliath. You, the individual policyholder, against a multi-billion-dollar federation of insurance companies with entire buildings full of legal experts. But don't let that intimidate you, because in this fight you have one thing they fear more than anything else: the truth presented to a jury of your peers. The first step isn't just finding a lawyer, it's finding the right lawyer. You don't go to a podiatrist for a heart condition, and you don't go to a divorce attorney for an insurance dispute. You need a specialist, a plaintiff's attorney who lives and breathes insurance law, specifically what's known as bad faith litigation. These are lawyers who have gone toe-to-toe with giants like Farm Bureau, State Farm, and Allstate countless times. They know their playbook, their tactics, and their pressure points. And here's the most important part for most people: you almost never pay these lawyers by the hour. They work on what's called a contingency fee basis. This is a game changer. It means their payment is contingent on them winning your case. They take a percentage of the final settlement or jury award, typically around 30 to 40%. If they lose, you owe them nothing for their time. This arrangement does two critical things. First, it gives you access to top-tier legal talent you otherwise couldn't afford. Second, it means the lawyer is just as invested in winning as you are. They won't take your case unless they genuinely believe in it, because they're betting their own time and money on the outcome. Once you have the right legal champion in your corner, the battle begins. It usually starts not with a bang but with a letter, a demand letter. This is your lawyer's formal opening shot. It's a detailed, meticulously crafted document sent directly to Farm Bureau's legal department. It lays out the entire history of the claim, the evidence of their wrongdoing, the specific laws they may have violated, and a clear demand for a specific amount of money to settle the case and avoid a lawsuit. It's the final "are you sure you want to do this?" moment. Sometimes this is enough. Faced with a credible threat from a known and respected law firm, an adjuster supervisor or an in-house attorney might reevaluate the claim and decide to settle. They know that fighting a lawsuit will cost them tens, if not hundreds of thousands of dollars in their own legal fees, win or lose. But if they ignore the demand or respond with another lowball offer, your lawyer files the lawsuit. This is the official start of litigation. A document called a complaint is filed with the court, which formally outlines your allegations against Farm Bureau. They are then legally required to respond with a document called an answer. And then comes the longest and often most crucial phase of the lawsuit, discovery. This is where the truth comes out. Discovery is the legally mandated process where both sides are forced to show their hands. Your lawyer will send Farm Bureau a list of written questions called interrogatories, that they must answer under oath. They'll send requests for production, demanding copies of every single document related to your claim. The adjuster's complete, unedited notes, internal emails and memos about your case, the training manuals they use, and even reports on the performance of the adjuster who handled your claim. This is where you find the smoking gun. Did an internal email admit they knew the initial offer was too low? Did the adjuster's notes reveal they ignored key evidence you submitted? Were they following a company-wide policy of delay and deny? At the same time, you may have to give a deposition. This is where Farm Bureau's lawyers will question you under oath, with a court reporter transcribing everything. It can be stressful, but your lawyer will prepare you for every step. The goal of discovery is for both sides to see the strength of the other's case. It's this process that leads to settlements in over 90% of lawsuits. Once Farm Bureau sees the evidence your lawyer has compiled, and they know what a jury will see, they often become much more reasonable. This is where Farm Bureau's unique federated structure can be both a shield and a sword. They might argue that the actions of one state's Farm Bureau have no bearing on another's. But a skilled attorney can turn this around. They can argue that a pattern of bad behavior in one state indicates a systemic, cultural problem. They can investigate whether the National Federation provides training or directives that encourage these bad faith practices. Because they operate so locally, they often rely on local law firms who know the local judges and the local jury pool. This can be an advantage for them, as they present themselves as the hometown company being attacked by an outsider. But it can also backfire if a jury of local citizens feels that their hometown company has mistreated one of their own. The entire legal strategy often centers on one powerful concept: insurance bad faith. This isn't just about a disagreement over the value of a claim. Bad faith is a claim that the insurance company acted unreasonably and without proper cause in denying or delaying your benefits. Remember, an insurance policy is a contract. You upheld your end by paying your premiums. Bad faith is the legal claim that they breached their duty of good faith and fair dealing that is implied in every insurance contract. Did they fail to conduct a thorough investigation? Did they unreasonably delay payment for months on end? Did they force you into litigation by refusing to pay a legitimate claim? Did they misrepresent the facts or the policy provisions to you? If the answer to any of these is yes, you may not only be entitled to the original benefits you were owed, but also additional damages for emotional distress, attorney's fees, and in some egregious cases, massive punitive damages. Punitive damages are the insurance industry's greatest fear. They are not about compensating you for your loss. They are about punishing the company for their behavior and deterring them from doing it to anyone else. A jury might decide that Farm Bureau must pay not just the $20,000 for your totaled car, but an additional $500,000 or even millions of dollars as punishment. This is the leverage your attorney has. This is why a case that starts as a simple dispute over a few $1,000s can transform into a high-stakes legal battle. The risk of a massive punitive damage award at trial is the single biggest motivator for an insurance company to offer a fair settlement. They are making a cold, calculated business decision. Is it cheaper to pay you now, or risk a much larger verdict from a sympathetic jury later? The lawsuit, the discovery, the depositions, it's all a calculated strategic process designed to force the insurer to do the right thing. It's about changing their financial calculation from, how can we save money by denying this claim, to how much will it cost us if we have to explain our actions to a jury. It's a long and arduous road, and it's the last resort, but sometimes it's the only way to get justice. However, this entire brutal, expensive, and emotionally taxing process, from the initial denial to the courtroom door, is a reaction. It's a fight that happens after the damage is done. But what if you could avoid the fight altogether? What if the most powerful move you could make wasn't hiring a lawyer, but something you did months or even years earlier? The ultimate power play isn't found in a legal complaint, but in the pages of your policy. Winning the war before the first battle is even fought is the real secret. And in our final part, we're going to show you exactly how to do it. It starts by fundamentally changing the way you think about insurance. Stop shopping for a price tag. Start shopping for a promise. The piece of paper you get from Farm Bureau, or any insurer, isn't a commodity like a gallon of milk or a tank of gas. It is a complex, legally binding contract that has the power to either save your entire financial future, or completely obliterate it. And the vast majority of people treat it with less scrutiny than they do the nutrition label on a box of cereal. The single biggest mistake anyone makes is logging onto a website, plugging in their info, and selecting the cheapest possible option that makes them legal. Being legal and being protected are two vastly different universes. State minimum insurance requirements are a joke. They are a political compromise, not a reflection of financial reality. In many states, the minimum property damage liability is $10,000 or $15,000. Think about that. The average price of a new car in the United States is hovering around $50,000. If you tap the bumper of a new Ford Explorer, a Tesla, or a luxury SUV in a parking lot, your legal state minimum coverage might not even be enough to cover the repair bill for a single vehicle, let alone a multi-car accident. So let's build your fortress. Let's arm you with the knowledge to turn your policy from a flimsy piece of paper into a shield of financial armor. This is the playbook. First, let's talk about liability. This is the coverage that pays for the damage you cause to other people. It's typically shown as three numbers, like 25/50/25. This is insurance code, and it's designed to be confusing, but it's simple. The first number is the maximum. In thousands, your policy will pay for bodily injury to a single person you hit. The second number is the maximum it will pay for bodily injury for the entire accident. And the third is the maximum it will pay for property damage. So that state minimum 25/50/25 policy? It means your insurance will pay up to $25,000 for one person's medical bills, a total of $50,000 for everyone's medical bills combined, and $25,000 to fix their car or any other property you damaged. Now imagine you're in a serious accident that's your fault. The other driver has two passengers. One has a broken leg requiring surgery and physical therapy, easily a $70,000 bill. The other has a concussion and whiplash, another $15,000. Your $50,000 total bodily injury limit is exhausted before you even get to the third person. You are now personally on the hook for the remaining $35,000, plus any claims from the third passenger. And we haven't even talked about their totaled $60,000 SUV, for which your policy only covers $25,000. Suddenly, you're facing a bill for $60,000 that you have to pay out of pocket. The other party's attorney will come after your savings, your investments, and even your house. That $30 a month you saved by choosing state minimums has just cost you your entire net worth. The absolute bare minimum any responsible adult should carry is $100/300/100. But for true peace of mind, you should be looking at $250/500/250 or even higher, often bundled with an umbrella policy. The cost difference per month is often less than a few streaming subscriptions, but the difference in protection is life-altering. Next, and this might be the most important coverage you can buy, uninsured and underinsured motorist coverage. UM and UIM. This is the coverage that protects you when you are hit by someone who either has no insurance at all, or who made the foolish decision to carry those state minimums we just talked about. You are a responsible person. You bought good coverage, but you can't control the person texting and driving in the lane next to you. If that person, with their pathetic 25/50/25 policy, slams into you and puts you in the hospital with $200,000 in medical bills, their insurance will pay their $25,000 limit and then wish you the best of luck. They'll tell you to sue their driver directly. But guess what? People who carry the cheapest insurance often do so because they have no assets to protect. You can sue them and win $1 million judgment, but you can't get blood from a stone. This is where your underinsured motorist coverage becomes your personal superhero. It steps in and pays the difference up to your own policy limits. It covers your medical bills, your lost wages, your pain and suffering, just as if you had sued a billionaire. It is, without a doubt, the single best buy in the insurance world. Declining this coverage to save $8 a month is one of the biggest gambles a person can take. You are betting your entire financial health that every single other driver on the road is as responsible as you are. That's a bet I would never take. When you talk to your Farm Bureau agent, you don't ask if you should get UM/UIM, you ask them to match the limits to your own liability coverage. Third on our list is medical payments coverage, or MedPay. In some states, it's called Personal Injury Protection, or PIP. This is a beautiful, simple coverage. It pays for your and your passenger's immediate medical expenses after an accident, regardless of who was at fault. Why is this so crucial? Because liability takes time to sort out. While the insurance companies are investigating for weeks or months to determine fault, the hospital wants to be paid now. Your health insurance might have a huge deductible. MedPay is your immediate first aid. It pays the ambulance, the emergency room, the x-rays right away, no questions asked. A $5,000 or $10,000 MedPay limit can bridge the gap and keep medical bills from going to collections while you wait for the larger claim to be settled. It's an inexpensive coverage that removes a massive amount of stress from a traumatic situation. Now let's talk about your car itself. Collision and comprehensive. Collision pays to fix your car when you hit something, another car, a pole, a wall. Comprehensive covers almost everything else. Theft, fire, hail, a deer running into the road, a tree falling on your car. The key here is the deductible. This is the amount you have to pay out of pocket before the insurance kicks in. People are often tempted to raise their deductible to $1,500 or $2,000 to lower their premium. The question you must ask yourself is this: if you walked out to your car tomorrow and it was gone, could you write a check for $2,000 without blinking an eye? If the answer is no, your deductible is too high. A $500 deductible is a safe, manageable choice for most people. Finally, don't skimp on the small stuff. Rental reimbursement and towing. For the cost of a couple of coffees a month, these coverages save you from logistical nightmares. If your car is in the shop for 2 weeks after an accident, a rental car can cost over $1,000. Rental reimbursement coverage handles that. It keeps your life moving. It allows you to get to work, take your kids to school, and live normally while your primary vehicle is being repaired. So here's your mission. This is your call to action. Tonight, I want you to go find your auto insurance policy. Don't put it off. Find the declarations page. That's the summary of your coverages. Look at those numbers. Is it 25/50/25? Or is it 250/500/250? Look for the lines that say uninsured motorist and underinsured motorist. Are there numbers next to them? Or does it say rejected or declined? Do you have MedPay? What is your collision deductible? You are no longer an average consumer. After sitting through this entire series, you are now in the top 1% of people who actually understand how this system works. You know the tactics, you know the structure, and now you know how to build your own defense. The ultimate power in the insurance game isn't held by the adjuster or the attorney. It's held by the person who had the foresight to buy the right contract in the first place. Your insurance policy is a promise. It's a promise that if the worst day of your life happens, someone will be there to help you put the pieces back together. Your job is to make sure you're buying a promise that is actually worth something. Call your Farm Bureau agent. Don't email, call. Have a conversation. Use the terms you've learned here. Ask them to quote you the difference between your current liability limits and 250/500/250. Ask them to explain why you shouldn't have matching UM/UIM limits. Challenge them. A good agent will welcome an educated client. You have the playbook now. You understand the game from the inside out. You're not just a policy number anymore. You're an informed, empowered consumer who has taken control of your own financial security. That is the real secret. That is how you win.